Hello, everyone. Today we're going to be talking about the Nexstar Media Group. My name is Jake.
Maxwell.
Madam. So for a little outline of our presentation, we're going to be doing an overview of their business, breaking down their revenue. I'll talk about some risks and financials, and then our two key growth drivers, which is advertisements and distribution. I'll do evaluation, see how our stock fits in the portfolio, and then summarize it at the end. So what is Nexstar? So Nexstar is America's largest local television and media company. They have over 200 stations and reach over 2/3 of the US population. They make money through advertising and distribution. And some key points is, like I said earlier, they have a wide base of infrastructure all across the country in many different markets. They have a successful history with their acquisitions and show consistency with their revenue and dividend growth. So we believe that Nexstar is slightly undervalued due to them paying constant dividends and having reliable revenue streams. So this is why we are recommending a hold and believe it should be reevaluated in 2025. So they have been consistently profitable. Their net income increases year over year. And in 2019 to 2020, that's where you saw a big jump, 252% increase. And this was due to some of their acquisitions that they made. So the acquisitions that they had was Media General, Tribune Media, The Hill, and CW Network. And this is what made them the largest US television broadcasting company. So like I said earlier, we are recommending a hold for the stock just because we are overweight in the communication services. So we need to lessen the weight, but we don't think it should be through Nexstar. They're currently trading around the $160 price point. They're like 164 today. We forecast that's going to have a 21% return and be at a target price of 193. So some challenges that the business has seen is that there has been an increase in popularity in their streaming services, but some opportunities for them is there is growth in emerging markets, and they're developing the ATSC 3.0, which is over-the-air signal. They'll improve the industry's quality and sound for their broadcasting. They say it's the biggest upgrade since HD in 2009. So their revenue their advertising revenue is split between core and political. And then on election years, political sees a spike in that revenue or a spike in the revenue. And they have distribution revenue as well. Some risk is that the streaming services are taking over. There is a dependence on revenue, so that can fluctuate based on how the market is doing. So this graph right here is their price for the last 5 years. As you can see, it's constantly going up. There was a little dip there during COVID, but it's been showing consistency of continuing to rise. They have a strong EPS and their ROE is consistent too.
Okay, so for an overview, I mentioned slightly, it's broken down in about 4 main segments of revenue, primarily advertising and distribution of content. On average, each year they have witnessed about a 17% increase, including the 48%, I would say, anomaly in 2020 around the COVID year. But when you break it down segmented, 2 main things that we would like to point out is since 2017 and through 2022, they changed from mainly advertising revenue to distribution, which we think shows that they are confident in the ability to produce solid content. And another thing to point out is in each election year, there are cyclical boosts in segmented political revenue. From an industry perspective, I would rate it about moderately positive. They formalize policies within one of their outlets called News Nation, where they want a neutral perspective on politics, and they don't want any contributions or whatsoever. They established a multi-year partnership with Feeding America and began the process of tracking their energy consumption. One of the main cons is that they have a 75% stake in CW Network, which is an indirect affiliation with Live Golf and Saudi Arabia. Saudi Arabia, as many of you know, has been criticized for the basic denial of women's rights. And the board of directors does also lack general diversity. 2 main risks I would like to talk about today would be debt and alternative media competition. When referring to the alternative media, mainly streaming services like Netflix and Disney, We find this as a not as big of an impact and probability as most would assume, because they focus on live content, mainly sports and news. Companies like Netflix and Disney are mainly focusing on the entertainment and not live broadcasting of things like news or sports. As for debt, they do have about $6.8 billion in debt, but we also do not think that this is going to be as much of an impact because they have a very high TIE ratio, proving that they are able to meet their debt obligations.
So when you look at our financials from 2020 to 2022, we've seen strong growth in our key profitability ratios. I'd like to bring a little attention to our debt to equity ratio. Typically, from an investor's perspective, a higher debt to equity ratio would be a reason not to invest. However, that can be attributed to our acquisitions over the last 5 years. And you can see in the last 2 years, we've actually been decreasing it as we continue to pay our debt off. And likewise, we have a consistent and strong ROE, which shows that we're able to efficiently use our shareholders' equity to generate profits. When you compare our numbers to our two main competitors, Tango and Gray Television, as well as the industry average, we're on par, if not better than all of them. So that shows that's another reason why we're the leading television broadcasting company in the United States.
Okay, so I'm going to talk about a little bit how they're making money. And the question I want to have you ask yourself is, where do you think TV is going? What purpose does it serve? Because that's what they are deeply entrenched in, is broadcasting. So revenue is gotten in core is from licensing out airtime on its channels, networks to advertisers. And this is on News Nation and Food Network, CW, a few that they have ownership in. And most of their advertising revenue is from automotive. So 18% of that is local, 22% national. This isn't an industry that we would think would be going away anytime soon. And then we touched on political. Political advertising is always a big cyclical jump that they have, with 10 times increase in 2020 from 2019. And I also was glancing at their 2022 annual report that just came out a few days ago. And 2022 was a record year for a non-presidential election year. And we can hit the next one. And so also I wanted to touch on over time, there's kind of this idea that streaming services are drastically displacing TV. And as we can see here, when it comes to local TV advertising, over this long span, there really wasn't much of a difference going on. You can see that there's some slight displacement there, but I would argue that that's pretty much on par with how Nexstar has shifted their business model. And they're heavily diversified across the United States, 200 channels in 116 different markets. And one of the big reasons why they had the giant jump in revenue from 2019 to 2020 was the acquisition of Tribune, which is 31 more stations that they got. And then they also just recently made a deal with YouTube TV, where they are hosting CW Network and others on there. And the other way that they make money, which is now the largest portion of their revenue, is distribution. And this is done through a process called retransmission. So other companies are paying them to retransmit their content on other channels, cable or online. And this has seen an average of a 20% increase in the last 5 years. But I want to draw your attention to the bottom corner here, the quote: "We anticipate continued increase in distribution revenue until there's a more balanced relationship between viewers delivered and fees paid for delivery of such viewers." So we would interpret this as for some reason, advertisers want to get in front of the eyes of TV viewers, and they're willing to pay for it. And so if you go to the next slide, I think the reason is we would say the content that is on TV is worth paying for. If you think about advertising locally, you're not really going to see that on streaming services or online. If you're going to do local advertising, it's done on TV. And this is where they're heavily embedded in that market. So they have great content, they have great credibility, and they have the breadth across the United States. And a quote here also from the CEO: "People do not go to Apple TV for news on the storm and the power outages. People do not go to streaming services to find out when the water is safe to drink." So I think that just kind of hits home my point here, is that they're local, but they also are showing they're in a market where people rely on that information, are still going to put their eyes in front of it. And we can go to the next one here. Let's talk a little bit about how we got their EPS calculation. This is just our baseline. And we broke it up in between their three main revenue generators. And you can see a big jump between 2023, 2024, and then so on for political. That's obviously due to the election years. And we did a 3% increase overall for their revenue. And that's pretty modest in our opinion, with an average of 17% increase. So very modest on that, but we wanted to keep it fair and projecting obviously maybe the market isn't gonna look so good in the future. And also I wanted to adjust political years for a 5% increase on that as well, which is also pretty modest. And here's our optimistic and pessimistic scenarios. The only things we changed was optimistic just did a 10% increase in revenue over what they already got. But the pessimistic, I want to touch on this flat revenue. Why wouldn't it be down or whatever? But excuse me. The flat revenue is because a lot of the times they're getting money from contracts and licensing agreements. So this revenue isn't just like based on fluctuations in the market day to day or anything. This is contracts that they've done for 3 years usually is how long they are. They just re-signed with ABC for till 2026. So that's guaranteed money that they're gonna get. So that's why the pessimistic scenario is just flat revenue. And if we lastly on our valuation, we have a range of 175 to 200 for our valuation, with obviously the different PE estimates there. And we kept the current PE and just projected it forward a year because the past 3 years it's been between 6.5 and 7.5. So we thought that was fair. And we got ourselves a baseline of 193, which is a 21.15% return roughly from where they are right now.
So when we look at the correlation matrix, typically speaking, a correlation coefficient that would be considered a strong correlation would be 0.7 or higher, which we don't see at all. Our two highest correlations are with General Motors and Prudential Financial. They can be explained because General Motors right now, our biggest industry right now for advertising would be the automotive industry. So that'd be a reason why we move similarly to them. And then Prudential Financial handles all of our retirement fund and health benefits for Nexstar. So that could also be another reason why we move similarly. When you look at the other two ones though, we really don't see a very high correlation with a lot of other stocks besides the red over on the right side, which makes it a good fit and why it's currently in the fund. So it's been a common theme today that the communication services or communication sector is currently overweight by about 10%. So we're allowed a 4% deviation from our target mark. So a minimum, we need to decrease the sector by 7%. And so right now, Google is recommending to sell half of their shares, which would only bring us down about 2.5%. However, if they sold all of their shares, we would drop by about 5%. As well as if Disney sold all their shares, we would be right around that period or that benchmark where we need to be. The future is just too bright right now to justify selling Nexstar, and that's why we're recommending the hold. So just to reiterate some of the main points we made today, Nexstar Media is the largest TV broadcasting company in the United States. We've seen increased revenue and net income over the past 5 years and even in the past as well. They have a good dividend payout that we've been realizing over the last 5 years as well. And then we've had a great history with our acquisitions. We recommend to hold Nexstar and reevaluate in 2025. We want to realize the profits from the 2024 political election, as well as our debt matures in 2027 and 2028. So right now they're currently in the process of paying it off. So we want to reevaluate in 2025 and see where we're standing with how much debt that still remains, because that'll give us a good indication of where it's going in the future if we do need to sell. And then our target price, like we said, would be 193 with a target return of 21%. Right now, Nexstar is hedged both directions of the future, whether the future is going more towards streaming services or if we're going to stick to traditional television. We've dipped our toes in both sectors, whether it's with the YouTube TV and the CW. And we've also doubled down acquiring more stations and getting a farther reach with television broadcasting as well. So we're in a position where we can pivot whichever direction we go, which is why we think the future is so bright for Nexstar.
Any questions? Some of the other groups have talked about a looming recession. What is your outlook, and what do you think the first expenditure companies cut is in a recession?
Well, I'll just touch on the fact that when it comes to communication services, there's a spectrum of what that entails. And on the far left end is wireless service providers and broadcast service providers, and that's what this is. So, and like I was talking about before with the quote from the CEO, this is a company that is probably going to be much more positioned to continue getting those revenues in a downturn. On the far other end of the spectrum is streaming services and other things of the sort.
So a lot of companies do cut advertising. But have you noticed, generally speaking, that political contests are, we're spending more money or less money on political advertising in presidential years and off-cycle years? Yeah, I think, I was in Oklahoma and they were talking about the Wisconsin Supreme Court election in 2023. So not only not a presidential year, but not even an off-cycle year. Totally off-cycle. So it just seems like, and this is where I'm agreeing with you, that it does seem like this company's positioned better than anybody else to capitalize on some of that political spending, and seems to be a little less sensitive to some of the other ad spending that maybe Google is.
Can you help me understand that a little bit better? I get that people spend on ads, but that means I get more Janet Protasevich and less David Gruber where I live. So to me, there are only so many seconds of advertisements to run. Are they charging more for them? Are they squeezing out their programming and running more ads? How is it that this volatility in revenue that clearly coincides with political campaign?
Yeah, I think that it's advertisers paying them to get their message in front of the audience. They're selling the audience pretty much.
Yeah. Are they selling it at a higher price? Those same 30-second ads, are they charging more to a campaign?
Based off their demand, yeah. So if I think the market's really good right now, more companies are gonna want to advertise, so they're gonna pay a little premium to get.
So there is a dynamic to the
There,
price.
yes, there's a number of factors.
All right. And then this is probably the third or fourth one I wanted to go back. Help me understand the debt of this company a little bit more. There've been a lot of acquisitions. They had a pretty high debt to equity ratio. Did we look at what type of debt do they own, or what type of debt did they use? Are they susceptible to the rise in interest rates that we've run through? Are they repricing some of that debt coming up? How significant is the debt to the future earnings that you forecast?
Well, the two forms of interest rates that they have right now are fixed from one up until 2027 and 2028. The one in 2027 is 4.7%. The one in 2028 is 6.25%. And they make in 2022, their interest expense in total was $332 million out of the $6.8 billion.
And they did refinance last year. I saw just skimming through the report.
So there's no looming problem here. They're going to be able to cover this debt that as it comes due. There's no repricing of debt coming in that we need to worry about.
Yeah, I think a big thing that we want to talk about was them just being a cash cow. We didn't put in the discounted cash flow method, but they make they're just a lot of cash generating, and they have been using that. They acquired a lot of debt to do some of these acquisitions, but they've been using it pretty well to pay off.
Yeah, they have such a high free cash flow, so that's why they're able to pay out dividends, stock buybacks, and they already have a plan in place to pay back their debt, pay down their debt.
So you did look at that. That's kind
Yeah,
of,
and that's another reason why we wanted to reevaluate in 2025 to kind of assess where they are standing with the debt, because if it's like you said, if it's they're not able to pay it down as much, then it'd be an indication maybe that we need to sell.
And I mentioned it earlier, like, I'm not sure if this means something to you guys, but their TIE ratio is about 6.5. I feel like a lot of people look for around like a 2.5. Their EBITDA in 2022 was 2.2 billion. And their interest expense compared to it was 332 billion, which is about a 6.25 ratio based on how they're covering the debt.
So free cash flow is a big piece of your guys' story.
I can
Yeah,
show this slide.
I guess my question is, then why didn't you talk about it?
Well, it's
These are very over.
yeah, these numbers, we thought that we was like, laughed out of the room if we were pulled up these numbers, but this is what we came up with for the discounted cash flow method, so. You know, we could have brought this up, but it's tough because, I mean, the stock's sitting at 160 right now, so.
Just with like how big their free cash flow is, it just inflates all of our numbers, so it's not really realistic.
So what do you think the market's missing then? I mean, if you're and you know, free cash flow is a big piece of the story. They're generating, you know, they bought a bunch of assets, they're not having to reinvest, kicking off a ton of cash, you're paying down your debt. And why is the valuation not higher than what it is? I mean, it's kind of an open-ended question.
I think kind of just part of that is, Nexstar is kind of behind the scenes, like, when you think of the sector, you're thinking of Disney or Netflix, they get all like the glam, where this is kind of just sits in like the background, kind of does the dirty work. And it's just been, being successful.
It's kind of a.
It's you, Casey, it's not the sexy pick. It's just getting to the grunt.
And then, can you guys talk a little bit more about, I'm a YouTube subscriber. How does that contract work with like the CW? They get paid a fixed amount to put that on, or do they get paid? You know, if I start watching CW and, you know, Tyler starts watching CW and all those cheap seaters down there start watching CW, do they get paid based on usage, or do, you know, like when it cuts to a commercial, it's the same 3 Kevin Hart commercials over and over again, do they get paid on those commercials, or how do they get paid by these streaming services? So if they start, you know, buying these networks and putting them out on the various ones, Hulu, for example, like how do they get paid?
I think this is part of the distribution revenue that they get, because they're creating that content and then it's going out to multiple different video distributors. I don't think that it's by viewership. I think that it's a contract that they are getting paid. And CW is the biggest one, but they got, I think those 59 channels that were now gonna be broadcast as YouTube.
They also didn't release a ton of information about how they're gonna be generating revenue, because it's new. I think this happened.
Yeah, it was March.
Yeah, I was just kind of curious, like
Yeah,
what
it was very.
the margins would be,
Yeah,
how that
yeah,
compared to what
yeah.
their current, you know, businesses are, and because you talked about the diversification, well, if you're diversifying, and let's say that really takes off, but the margins are a lot less.
Right.
It's gonna hit you in the future, right? So we're just trying to get a feel for what that might be.
Yeah, they did take on a lot of debt with acquiring these new networks, and that's kind of another reason why 2025 is a number that we've kind of tossed in the middle there, because that is the big question that's in the air, whether or not this kind of new business venture area that they've kind of dipped their toes into is going to be profitable and pay off before their debt comes due.
Can you go back to your revenue history slide? We were looking at the big jump in 2020 and you made a comment about the COVID year.
No, I'll keep going. It's like 4.
Oh,
No, other way.
There you go. So the big jump in 2020. Was that political? Was it COVID? Oh, was it, because that's a presidential election?
Yeah, we initially thought that it was political. The political did influence it, but political in total is still, with a giant jump like that, is still like 8% or 9% of the total revenue. So it is because of those acquisitions that they had came in that year.
well, this next one will show.
Yeah, it was the breakdown too.
Yeah, so
Oh, there it is. Okay.
the political jumped,
But that was post acquisition. So they got a pop from the acquisitions, but there isn't. So even though you see a fall off in political advertising, 20 to 21, total advertising, when you go back to that previous slide, is still higher.
Yeah.
And so when you, in your projections, where you don't show any volatility like that, you do show jumps in political years, but then basically holding at those levels into the next.
Well, I decreased the core when I increased political, because a lot of times that's what's stealing from.
You go to this. Keep going. I miss it.
No, yeah, it was back. Right there, yeah.
Yeah, right there.
Are they in this market?
What's that?
Nexstar? If I turn on.
Oh, yeah, they're in the Crosse, yeah.
That's the Crosse,
Yeah,
okay.
yeah. Yeah, and Eau Claire. Yeah, they're all over.
Are they still acquisitive, looking at growing that footprint? Or have they reached a point now where they're like, hey, this is a pretty good,
There's some growths there. So, like I earlier said, there's like this new technology that they say is like revolutionary for the industry. It's ATSC 3 or Next Gen TV. So they believe that will spread just more reach to audiences and it just boost like how their thing is transmitted and just improve the quality overall.
Yeah, but and you're asking a little bit about like new markets in like the United States they're gonna go to. I think the sense that I get is they're kind of pausing a little bit after the 2020 acquisitions. And they're kind of thinking about this network stuff and just keeping eyes on that.
investing internally in that type of technology?
Yeah, so that's not through them. It's a different company doing that, but they're like one of the main drivers in getting this push through. So and this is just like for the industry in total. So this is kind of their projections for what the revenue could increase once this is released. So it technically is released now, like 50 markets have it. It's still ATS or ASTC 1 is still in play right now, but they have been like working with Sony and like the new TVs that are gonna make their new TVs 3 compatible. So and then they just gotta wait till the FCC like loses in or like lets them kind of push this fully through, and that'll be around like 2025 when they think this can take off.
So are they an investor or are they a benefactor of this technology?
They use it.
But they didn't have to put money into,
I don't believe so, no.
what are their capital expenditures? Do they have to make upgrades to any technologies or they just have overhead costs, administrative costs? What is their expenses look like?
I think it's pretty low. The obvious as far as like updating or keeping up on technology, I think this is mostly it. I think once they have the infrastructure, it's just there and it's just kind of running.
So let me re-ask the question. Do they have needs for capital expenditures to invest in technologies? Or they're not really involved in that? That's a third party doing the technology. They just
Yeah,
utilize.
so this is third party, so they're not investing their money into this. This is kind of just like revolutionizing the over the air, how it's transmitted. So this would allow for like 4K and there's audio.
Why I'm asking is you talked about all the free cash flow they have and then they're gonna pay off their debt. What I wanna make sure is there's not gonna be this technology spend need down the road that they have to use that free cash flow for and then the debt becomes a burden, but it sounds like there isn't.
And
that
with
type of expenditures.
with them like working with Sony and LG and those companies, when they're making their new TVs, they're making it compatible with this, but that's not coming out of Nexstar's pocket.
Got it. Thank you.
But local Crosse News, when they're broadcasting that building, that satellite, that technology, that's owned by Nexstar. So they do have some technology and infrastructure investments that have to take place and upgrades and salaries and expenses and content development and all that. That's still part of their operating expenses.
And I think this will also too, it expands the well as part of it. When they do the upgrades.
This is something they can buy. How is that their competitors cannot buy it? How is that an advantage?
The competitors can buy it. There's actually, I did glance, you're talking about the technology on their website, Tenga and Gray, I think it was Gray. I just saw some other competitors had sponsored the technology. So they would be a little more involved and Nexstar did not decide to be like a sponsor of it. But they still intend on using it.
It's because of the market regulations, like, but there's a local Fox, are you talking about like, the other TV can come into La Crosse and advertise? Wouldn't it be, I'm kind of probably answering the question for you, but like, there's only one local Fox, one local CBS, like, I don't think Gray can come through and make their own.
Cannot commit.
Yeah, I don't think I think it isn't it very restricted from a. I don't know if it's regulatory or like. Licensing maybe is the correct word.
Yeah.
And then my just dumb question, because this would be like your old rabbit ears. You don't pay for, so this would be like the cord cutting of, before cord cutting. How would they make, I guess, how do they track that? Like if I get rid of my YouTube TV and I start doing ASTC, thank you for saying that acronym. There's way too many acronyms in this world. To tell people what it actually
You
means.
can call it next gen TV.
Yeah, next gen TV, okay, so I get next gen TV, everyone here gets next gen TV. How do they track that if I'm pulling it off the airwaves to know that we need General Mills needs to pay Nexstar more for their Lucky Charms advertising? Do you get what I'm saying? Like, like right now, YouTube knows that I'm on when I'm on because I'm logging in and I'm going through it. But if I'm pulling this over the air, can they track that somehow? And then how does that correlate to, hey, advertisers, I have more eyeballs because I have ATS 3.0.
No, I think they do know. I think it starts at the beginning though. It's written in like the contract that they do. So what they are able to charge for it, and how many like screens are on it.
They'll be used how like 1.0, what we currently have is gonna be used as just this is gonna like immensely improve it.
Yeah, I'm just curious, because if it's free and no one knows, like, does anyone know that I'm pulling this out of the universe onto my TV? You know what I'm saying?
Yeah, I don't know for sure. I'd
Like,
assume that they have a way to track
You
it.
may, I'm not saying you need to have an answer to this. Yeah, like radio, exactly. It's the same idea. Thank you.
You remember the old Nielsen household surveys?
Yeah.
I think they still do that.
Yeah.
I just,
Who
I
answers
filled one
those?
out.
Raise your hand.
I answered one time.
Did you?
Yeah, they give you $5. And then you fill out the survey for a week on what you watched and when, and then
Did
you
you
send it
did
back.
you update your retirement spreadsheet after you got that?
Sure did.
did.
It was spent before I got it.
And then two, you brought it up, like the first question with just like potential recession downturns. The great thing with Nexstar is like people aren't gonna spend their disposable income. They're gonna stop their subscriptions if they're trying to save money. They're not gonna have 4 different subscriptions to Disney, Google, or not Google, but Netflix and all those things. But they still need somewhere to watch the news. They still need local TV, and that's why this is very like recession-proof company.
Because even if you just have like a base model TV with like an antenna or whatever,
Satellite, yeah.
satellite, you'll still be able to pick up the local like stations that Nexstar broadcasts.
You just walked into my bear trap. I asked the same question to another recessionary question in the previous group. So they're still resilient in recessions. Did you guys go back and look at the last 4 or 5 recessions to see how Nexstar stock price is done compared to the rest of the market or its competitors?
Well, they were in 1996 was when they started.
Okay,
They've been pretty small, I think, until the late thousands. So I know the COVID one we have. I don't know about the other ones.
so you're making bold statements about anything to back it up.
Pretty much.
I'm just kidding.
Yeah.
Sorry.
All right. That was a good answer.
Good job.
We're around.